Hi everyone, Bob here. Welcome back. In our last episode, we looked at the S&P 500, a market where you can sell a stock and get your cash in seconds. But today, we're heading into a corner of finance where getting in is easy, but getting out is becoming a major problem. We're talking about private equity redemption issues. You've seen the headlines lately? Giant fund limits withdrawals or investors stuck in private markets. Why are some of the world's biggest firms acting like the Hotel California, where you can check in, but you can't always leave? Let's put the time on the clock and find out why the exit doors are locking. To understand this, we have to talk about liquidity. Public stocks are highly liquid. You sell them, and the money is yours instantly. But private equity funds don't buy stocks. They buy things that are incredibly hard to sell, like massive office buildings, hospital chains, or fleets of ships. You can't exactly sell a skyscraper on a Saturday afternoon just because you need some quick cash. Recently, firms started offering retail-friendly funds to regular investors. They promise the high returns of private equity with the ability to pull your money out monthly or quarterly. This created a massive liquidity mismatch. The fund owns slow-moving buildings, but the investors expect fast-moving cash. As long as the market was booming, it worked. But once things cooled off in late 2025, the math stopped adding up. So what happens when everyone wants their money back at the same time? As interest rates stayed high in early 2026, nervous investors started hitting the exit button. But because the fund hasn't sold those underlying buildings yet, it doesn't have the actual cash to pay everyone back. To prevent a total collapse, funds use something called a redemption gate. This is a rule in the fine print that says, if too many people ask for money at once, we have the right to stop or limit payments. We've seen major firms like Blackstone have to gate their funds recently, only allowing investors to take out a tiny fraction, sometimes just 2% of what they requested. Suddenly, your liquid investment is frozen solid. This creates a dangerous psychological effect. When a fund limits redemptions, it often panics the investors who weren't even planning to sell. They think, I better get in line now before the gate closes even tighter. This flood of requests forces the fund to sell off its best assets quickly, leaving remaining investors holding the lower quality stuff no one wants. Regulators are now stepping in, asking if these funds were marketed fairly to everyday people. It's a classic reminder. Higher returns usually come with hidden costs. And here, the cost is your freedom to move your own money. Private equity isn't built for speed. It's built for the long haul. If you're looking at these funds, always check for those gate provisions. I'm Bob, and that's the Redemption Crisis. Don't forget to like and subscribe. See you on the next one.